Hello everyone. Today we are going to start our topic income under head capital gains. This topic is one of the income source which is used to be calculated under total income of an assessee while calculating the income tax act. In this chapter we are going to understand about basis of charge of the capital gain, capital assets, type of capital assets, holding time of the capital assets, computation of capital gains, treatment of compensation, capital gain in case of insurance, capital gain on transfer of capital assets, etc. As per section 45, profit or gains arising or transfer of a capital asset shall be chargeable under the head capital gains. Following are the conditions to be satisfied to change any income under the head capital gains. There must be a capital asset. The assessee transfers such capital asset. Third, there must be profit or gain, including negative profit or gain on such transfer. The transferred asset should be capital asset at the time of transfer. So let's start with this chapter. First is basis of charge. Capital gain shall be taxable in previous year in which the asset is transferred. However, in some cases, capital gain is taxable in the previous year in which consideration is received rather than in the previous year in which transfer took place. Example, compulsory acquisition by the government. Next, as we are talking about the profit on the capital assets, so we should know before what is capital asset. Capital asset means any kind of property held by an assessee whether or not in connection with his business or profession, any securities held by a foreign institutional investor which has invested in such securities in accordance with the regulations made under the Securities and Exchange Board of India 1992. Further, capital asset may be movable or immovable or tangible like furniture, jewelry, etc. Intangible like goodwill, tenancy right, copyright, etc. Here, property includes any rights in or in relation to an Indian company, including rights of management or control or any other rights whatsoever. Property does not include the following. First, stock in trade, consumable stores or raw materials held for business or profession. However, any securities held by a foreign institutional investor which has invested in such securities in accordance with the regulations made under the Securities and Exchange Board of India 1992 shall not be treated as stock in trade. Such profit shall be taxable under the head profit and gains of business or profession. It is not included in the calculation of capital gains. Second, personal effect. Here personal effect means any movable property held for personal use of the assessee or for any department or dependent member of his family, but it excludes followings like jewelry, paintings, sculptures, drawings, any work of art, and archaeological collections. Next, agricultural land in rural areas. Agricultural land in India is not a capital asset except the following: land which is situated within the jurisdiction of any municipality, whether known as municipality, municipal corporation, notified area committee, town committee, or by any other name, or cantonment board having population of 10,000 or more, or in any area within the distance measured aerially, like more than 10,000 but not exceeding 1 lakh, more than 1 lakh but not exceeding 10 lakh, and more than 10 lakh. Treatment of profit on sale of agricultural land in rural area of India shall not be treated as capital gain. Such income is in the nature of capital receipt and hence shall not be taxed under any head. Next, gold bonds. Gold bonds issued by central government are not capital asset like 6.5% gold bond 1977, like 7% gold bonds 1980 and National Defense Gold Bond 1980. Special bearer bond A special bearer bond 1991 issued by central government are not capital asset. It is not necessary that assessee should be the initial subscriber in case of special bearer bonds. Next, gold deposit bonds. Gold deposit bonds issued under the Gold Deposit Scheme 1999 or deposit certificates issued under the Gold Monetization Scheme 2015 notified by the central government are not capital asset. Interest on any such gold deposit bonds are exempted. Next, we will talk about types of capital assets. One is short-term capital asset and another is long-term capital asset. Short-term capital asset means a capital held by an assessee for not more than 36 months immediately before the date of transfer, whereas a capital asset which is not short-term capital asset will be treated as long-term capital asset. In the following cases, an asset shall be termed as short-term capital asset if it is held for not more than following period before the date of transfer. First, equity or preference shares in a company, any security like debenture, government securities listed in India, a unit of an equity oriented fund, zero coupon bonds, units of UTI, if it is held not more than 12 months before the date of transfer, then it will be treated as short-term capital assets. Moving further, while computing the period of holding of any asset, the following points are to be considered. First, period after liquidation. Second, date of transfer. Third, conversion of preference shares into equity shares. So, in case of liquidation, if a company goes into liquidation, the period after the date of commencement of liquidation is to be excluded for the purpose of period of holding. For calculating the period of holding of a capital asset, the date on which the asset is transferred is to be excluded. In case of conversion of preference shares into equity shares, period of holding includes the period for which the preference shares were held by the assessee. Similarly, period of holding of units in the consolidated plan of the scheme of the mutual fund includes the period for which units in a consolidated plan of a mutual fund scheme were held by the assessee. Now next, some provisions illustrated. The asset can be classified as, here in this chart you will see items are mentioned, period of holdings are mentioned and nature of asset is mentioned. So it is on the basis of holding the months, the nature of asset is going to be decided. In case of jewelry, more than 36 months, long-term capital asset. Listed shares more than 12 months, long-term capital asset. Shares in Y Private Limited or any private limited more than 24 months, long-term capital asset. Residential house more than 24 months, long-term capital asset. Units of UTI less than 12 months, short-term capital asset. Zero coupon bonds more than 12 months, long-term capital assets. Drawings more than 36 months, long-term capital assets. Unlisted shares less than 24 months, short-term capital asset. So in this chart we discussed about the various items and the period of holding, and on the basis of period of holding we are categorizing them into long-term and short-term assets. Now we will discuss about the term transfer. Transfer in relation to a capital asset includes sale, exchange and relinquishment of the asset, extinguishment of any right of an asset, compulsory acquisition of an asset under any law, conversion of asset into stock in trade, any immovable property, any transaction which has effect of transferring or enabling enjoyment of any immovable property, maturity or redemption of zero coupon bonds. This transfer may also include disposing of or parting with an asset or any interest therein, or creating any interest in any asset in any manner whatsoever, directly or indirectly, or otherwise, notwithstanding that such transfer of rights has been characterized as being effected or dependent upon or flowing with the transfer of share of a company registered or incorporated outside India. Moving further, transactions not regarded as transfer. There are so many transactions which are not to be treated as transfer. Some of them are here mentioned in this chart. In this chart, you will see the section, one column, and transactions which are not regarded as transfer. Any distribution of capital asset in the event of liquidation by a company to its shareholders shall not be treated as transfer in the hands of company. Next, any distribution of capital asset on the total or partial partition of an HUF, any transfer of a capital asset under a gift or will or an irrevocable trust. Next, any transfer of a capital asset by a 100% holding company to its Indian subsidiary company. Such transactions will not be treated as transfer. Some more transactions, any transfer of capital asset by 100% subsidiary to its Indian holding company. Any transfer in a scheme of amalgamation. For this, transfer must be in scheme of amalgamation and transferee company must be an Indian company. Next, any transfer by a shareholder in a business reorganization. Next, any transfer in case of merger of capital asset, any transfer in a scheme of demerger, such transfer in a scheme of demerger by the demerged foreign company to the resulting foreign company. Transferred asset must be capital asset being a share or shares held in an Indian company. Next, any transfer in a business reorganization of a capital asset by the predecessor or cooperative bank to the successor cooperative bank. Any transfer in the demerger and capital assets. Next, any transfer of a capital asset being bond globally distributed, receipt, rupee denominated bond, derivatives, or other notified securities. Now, we will learn about computation of capital gains. As we have discussed, short-term capital gain and long-term capital gains are arising after the transfer of short-term capital assets. So, for computation purpose, let's see how the computation of short-term capital gain is done. Sale consideration, full value of consideration as mentioned in the particulars. Then from this sale consideration, any expenses made for this sale consideration will be less from this amount, and then we can get the net sale consideration. From the net sale consideration, we have to deduct cost of acquisition and cost of improvement if any incurred on this asset. Then afterwards we will get the short-term capital gain. After calculating the short-term capital gain, we deduct the exemptions provided under section 54B, 54D, 54G, etc. Then the amount came will be taxable short-term capital gain. Hope you understand the method of calculating taxable short-term capital gain. Moving further, computation of long-term capital gain. Same. First, we have to calculate full value of consideration. Then we have to deduct expenses on transfer if incurred. Then we will get net sale consideration. After this, we will deduct indexed cost of acquisition. Then we will deduct index cost of improvement. After deducting these amounts from net sale consideration, we will get long-term capital gain. From long-term capital gain, we will deduct exemptions under section 54, 54B, 54D, 54EC, 54F, etc. Then only we will get the taxable long-term capital gain. Now, how we can calculate the index cost of acquisition? And what is index cost of acquisition? It means price level of the year of sale which is adjusted on the basis of indexation. So for calculating indexed cost of acquisition, we do the indexation by the method of using index of the year of transfer and index of the year of acquisition. Same, we will do the treatments for the index cost of it. For calculating index cost, we have the chart of indexation provided by the income tax department in where financial year index is given for every financial year. Moving further, treatment of assets acquired before 1st April 2001 means if any asset acquired by a company, business or assessee before 1st April 2001, then what will be its treatment if cost of acquisition is there and cost of improvement is there, and how the indexation will be done. It is mentioned in this chart. So actual cost of acquisition and fair market value of the asset will be determined, and higher of the following will be treated for the purpose of cost of acquisition. For the purpose of cost of improvement, any cost of improvement incurred by the assessee or the previous owner shall not be considered if it is before 1st April 2001. Moving further, deemed or notional cost of acquisition. In certain cases, cost of acquisition of the previous owner of the property shall be deemed to be the cost of acquisition for the assessee, like assets received on total or partial partition of HUF, assets received under a gift or will, assets received by succession, inheritance or devolution, assets received on dissolution of firm, assets received on liquidation of a company, assets received under trust, assets received under business organization subject to certain conditions, and assets received by HUF from its members. Also, in certain cases, cost of acquisition of capital asset shall be where capital asset being equity share of a company become the property of the assessee on conversion of preference shares into equity shares of that company. The cost of acquisition of corresponding preference shares shall be considered as cost of acquisition of such converted equity shares. Next, assets converted under section 56 subsection 2. Next, conversion of inventory into capital assets. Also, where the capital asset being share or shares of company is acquired by non-resident assessee on redemption of global deposit receipts referred to in section 115 AC held by the assessee, the cost of acquisition of the share or shares shall be the price of such share or shares prevailing on any recognized stock exchange on the date on which a request for such redemption was made. In case of capital assets being declared under income declaration schemes, the cost of acquisition of the asset shall be deemed to be the fair market value of the asset which has been taken into account for the purpose of the said scheme. Now, cases where indexation benefit is not available even on transfer of long-term capital asset. First case, debenture or bonds. In case of transfer of bonds and debentures other than capital index bonds issued by the government or sovereign gold bonds issued by RBI under the sovereign gold bond scheme 2015, indexation benefit is not available. Second, slump sale, transfer of an undertaking or division in a slump sale, also indexation benefit is not available. Equity shares and equity oriented funds refers to section 112. Next, certain transaction by a non-resident, transactions like in case of a non-resident, capital gain arising on transfer of shares in or debentures of an Indian company acquired in foreign currency, it will be computed as per first provision of section 48. Next, transfer of global depository receipt. In this case also indexation benefit is not available. Now, notional sale consideration. In some cases, notional sale value is considered rather than actual value. So, what are the cases where the value of consideration will be deemed? In this chart, you will see three columns: section, case, deemed value of consideration. First case, insurance claim received on damage or destruction of capital asset. In this case, compensation received in cash or fair market value of asset received as compensation will be deemed as value of consideration. Second, conversion of capital asset into stock in trade. Fair market value of the asset as on date of such conversion will be deemed as value of consideration. Case third, transfer of capital asset by a partner member of firm, association of firm as capital contribution, then the amount recorded in books of accounts of the firm AOP, BOI as value of such assets will be deemed as consideration amount. Next case, transfer of capital assets by a firm to partner member by way of distribution on its resolution. In this case, value of consideration will be fair market value of the asset as on the date of transfer. Next, asset received by shareholders on liquidation. Money so received or the market value of other asset on the date of distribution as reduced by the amount assessed as dividend under section 2 subsection 22 clause C. Next, shares, debentures or warrants transferred by the employee by way of gift or under an irrevocable trust. In that case, market value of the asset as on date of such transfer will be considered as value of consideration. Next, transfer in case of land or building or both. Value determined for payment of stamp duty will be considered as value of consideration. Moving further, capital gain in case of insurance claim. As per the Supreme Court case in CIT versus Vanya Silk Mills Private Limited, any compensation received as insurance claim for loss of capital asset shall not be taxable. However, with effect from 2000-2001, Section 45(1)(a) has been inserted, which nullify the impact of the above case law to some extent. As per provision of this section, any compensation received from an insurance company for the specified damage is treated as transfer. Such transfers are liable to capital gain in the year of receipt of compensation. Causes of damages. Cause of damage, as we see in this diagrammatic representation, cause of damage may be specified or other. If it is specified, insurance claim received or not, no claim received. If insurance claim received, treated as transfer, thus liable for capital gain. If there is no claim, then no capital gain. Causes of damage other than specified damages, then in that case no transfer. So only in the case of specified damages, if insurance claim received, then that income will be treated as transfer and liable for capital gains. For computation of capital gains, various terms to be interpreted as under sale consideration if compensation received in cash or in kind, cost of acquisition, cost of improvement, expense on transfer as usual means the original expenses, index benefit available till year of destruction, taxable in year of receipt of compensation, tax rate as applicable in the year of receipt of compensation. Capital gain on conversion of capital assets into stock in trade. Sale consideration and fair market value as on date of conversion. Cost of acquisition, cost of improvement, expenditure on transfer will be treated as per the expenses. In case of index benefit available, yes, till year of conversion. Taxable, yes, in the year in which stock is actually sold. Tax rate, the applicable rate at that time. Treatment of difference of actual sale value and fair market value as on date of conversion. Actual sale value minus fair market value on date of conversion minus expenditure on transfer shall be treated as business income. Now, computation of capital gain in case of depreciable assets. So, what are depreciable assets? Example, a residential house property being not used for business purpose on which no depreciation is allowed under Income Tax Act shall be treated as non-depreciable asset. Whereas if the same house is used for the residence of employee of the business and depreciation has been claimed under Income Tax Act, then it shall be treated as depreciable asset. Nature of capital gain. In case of depreciable asset, capital gain arising on transfer of depreciable asset shall always be a short-term capital gain. Benefits of indexation cannot be claimed on such asset. Computation. For computation of capital gain on transfer of such asset, depreciation under section 32 of the chapter profits and gains of business and profession are applicable. Moving further, hope you all understood with this topic income from capital gains. Thanks.